In the market recently, we've been hearing a lot about price sensitivity. We've been hearing a lot about inflation and high costs of everything. One example specifically is there's a 2-bedroom, 1-bath apartment unit that is renting better than a 2-bed, 2-bath apartment unit. And I've never seen that in my 20-year career where someone would not take the additional bathroom for a $50 to $75 upcharge. This whole deal revolves around price sensitivity, and we are primarily staying under that $1,400 per unit, and that's the target we've been advised for RPME to stay under. Anything under $1,400 is reasonable rents, and we're finding that they're getting sticker shock on almost everything that they're buying these days, and these apartments are the one thing that they actually think that they're getting a good deal on because it's brand new construction. Very, very nice interiors. We've stripped out all the amenities to reduce the costs. So their month-over-month costs are much lower than what they would expect for such a high-end product.
So there you go, guys. I'm here with my partners, Dustin and Caleb, to talk about Jefferson Reserve Phase 2. They will introduce themselves in the moment. But basically, here's the deal. Dustin is a lead visionary. He comes up with the designs, and Caleb and Dustin work hand in hand to do the development. Caleb is the lead developer on this project. Our company and myself, Boardwalk Wealth, we are part of the overall team to do the asset management, raise the equity, help with the financing. Caleb does an exceptional lead role there as well. Quick housekeeping, though. If you're first-time investors, you can reach out to us and our teams. More than welcome, happy to walk you through the legal documents, any terms or processes you're not familiar with. My goals on this webinar and our team's goal on this webinar is to give you an idea of not just what the project is, what the story, what the background is, but also to give you an idea of what type of returns should you expect. Because we've been iterating this reserve style project over the last, 6 or 8 projects now, we've been able to really hone in and strip out all unnecessary costs and fluff. So our investors in this particular case can expect IRRs around 119.6 to 20%. That's roughly what we're targeting, 1.9 to 1.93x equity multiple. That gives you a rough idea. Also on the tax breaks, we are energy efficient building. Credit to Caleb and his team there. He's going to talk more about that. Investors can expect anywhere from 20 to 30% tax breaks on their money plus tax credits. So that's it in a nutshell. I'm not going to go to the team section. As you all know, I'm Omar Khan. I'm the founder of Boardwalk Wealth. We are a leading asset management and acquisition and development company. We have assets in the Southeast, the Midwest, and Sioux Falls, South Dakota. We do acquisitions as well as developments. I'm joined by Dustin. Dustin, do you want to introduce yourself? And then Caleb, you take it away.
I'm Dustin Hendrickson. I'm the lead visionary, and I love design, the design aspect, and meeting all the tenants' wants and needs.
Hi, I'm Caleb Veldhouse. I'm the owner and founder of Veldco. We do the development work, the bare ground development work, and then the general contracting work. So I like to see the project start from scratch, hand the keys off to Omar when it's done.
Thank you, guys. So Caleb, can you kind of take us back all the way to the first time we found the land for Jefferson Reserve? How did we go in Phase 1? What's going to happen in Phase 2?
Yeah, this goes back about 18, 20 months ago. I was actually part of a breakfast group, and one of the guys in the group had the land for sale. It was about 6.7 acres total, and it was actually zoned live work instead of just your typical traditional multifamily housing zoning. So the conversation just kind of started happening, put 2 and 2 together. We were looking at a piece of property right next to the brand new Jefferson High School that had just opened about 6 months before this. And so, we put 2 and 2 together and we started talking, and then we worked through the design, bought the property last July and started construction a little over, not quite a year ago, actually, last November. And right now we wrapped up building 1 in Phase 1. We're about to wrap up building 2 in the next few weeks, and then building 3 shortly thereafter. So we'll get into a little bit of the details of how well that lease up is going, but the construction has gone according to plan. We haven't really had any surprises along the way. And what's really nice is going into phase 2, we know the land, we know what it's going to do, we know the dirt structure, all of that stuff as we move forward. So we're really excited to get started.
Wonderful. And Dustin, do you want to talk us about some of the learnings from phase 1? I mean, you've had a lot of them, especially some interesting observations around 2 bedrooms, 1 bath, what you're seeing out there in the market.
Yeah, the 2-bedroom, 1 bath was very shocking to me. It's the first time that I've heard that was in more demand than the 2-bed, 2-bath. So we had to chew on that piece of news for a little while because I've been in this industry for 20 years and I've never heard that. That's the first time. So that's just showing a level of price sensitivity. A couple other things that are really interesting. This project has a Starbucks right across the street. And so we don't need to provide any type of coffee amenities in the main lobby. I don't even think we have a main lobby, honestly. All that stuff stripped out of these projects. We have very few hallways. Only the 36 unit building has a hallway. The 24 unit buildings that we have don't have hallways. They just have individual stairwells. Miles signed something with Anytime Fitness for a gym membership program, and that's across the street. And it's a much better gym than we could offer our tenants. It's the second fastest growing Anytime Fitness location in the nation. So that also just shows you how much growth is actually happening in this area as well. One other thing, design wise, we've got a lot of compliments on the building because the way it sits, phase 1 kind of almost feels like it juts out into the street a little bit, and it sits really tall off the ground because the way that everything laid out. So we have this terraced ground that comes up to meet the building, and then the building kind of stands out. So it really grabs people's eye. I think that has a little bit to do with the success and the marketing of the building. It really stands out. I got a lot of compliments on this building, more than any other building, just for passerbys. They knew that it was one of our design buildings, and that we got a lot of compliments without bringing up this building. So it definitely sticks out when you drive by it. You can't help but not see it. There's some competition in the area, and that competition kind of blends into the background where ours really stands out and sticks up. Plus, being right next door to Jefferson High School, there's a big green barrier. Like, there's lots of grass and trees in between. So there's density on our site, but it feels as if there's not very much density because everything around it has lots and lots of green space. So we took advantage of that as well.
So, and just to, bring people back, remind them. So Caleb, like, we've delivered the first building in under 12 months, right? Like, what was it, 10 months or so, give or take?
Yep, 9 and a half, I think.
9 months, right? And the second building now is going to be delivered in the next few days. And so what does that bring us to? In about 12 months or so, we've delivered 2 buildings, 2 out of 3 buildings, by the way. And this is the power of the reserve style build lease projects that we've always been saying. If you're looking at a typical wrap or podium finish, we've all seen these in Texas, Florida, all these other markets. All developers say they're going to build these in 18 months. At a minimum, it takes 20 to 22 months just to deliver them. Then you get your certificate of occupancy. Then people start moving in. So as you can see, you're really getting stability around month 30, 32, if you're lucky, and the lease up goes according to plan. Here, as an example, we're already 30% plus leased within 12 months of the entire project. On Briarwood Reserve 1, as an example, we are 95% leased within about 15 months from the time Caleb and Dustin started developing. So that gives you an idea, whereas you can have the regular conventional style project start basically leasing and stability is around 30, 32 months. We have already cut that down in time, in some cases by half. The other deal is, and we are seeing this more and more happening across the country, a lot of the stuff that you were seeing in these conventional buildings in the last 10 years, where there was an amenities arms race, was because money cost nothing. It was zero interest rates. And now that money has a cost associated with it, a lot of the frou-frou stuff, a lot of this fancy bells and whistles, they're going away. Or developers that have not innovated, they're finding their projects impossible to pencil. Lenders are not lending on these projects, whereas folks like us We are continuing as business as usual because we want to target the missing middle. A lot of talk that's around rental rates being sky high is because the costs to develop these properties are sky high. In Texas, in some case, if you're going out today, your total cost, hard, soft, land, fees, is about 240, maybe 230 if you really go to about 250 to 60,000. This means that the rent you have to charge, your studios are going for $1,800, $2,000, $2,200 in some case. Whereas for us, we can come in at a lower price point because our costs are lower, meet the market's desires and needs because the market is very price sensitive, and especially in a high interest rate environment, make these projects pencils. Not a lot of other developers can do that. And it doesn't take a rocket scientist to figure out that if your project pencils in a high interest rate environment, well, in a low interest rate environment, all the interest savings, all the debt service savings, they go directly to the bottom line. So that's why this is such a powerful project. It's nimble and flexible construction. You reach stability and cash flows faster. These projects work in today's time, and they're an exact match for the type of resident that we have today, the missing middle that's very price sensitive.
I've started hearing some complaints about amenities because what happens is there's so many amenities in these buildings and the maintenance costs are much higher than they had anticipated because maintenance costs just seem to be going up and up. And a lot of these amenities aren't fixed properly, so they're broken, and they're actually a detriment to the property when they're not maintained well, but there's not enough money in the budgets to maintain them properly. So I've also heard that amenities can be a detriment to your property if they're not maintained well enough. But onto location. Yeah, location right next to the high school, right on Marion, and it's within it's within a big education center. So you've got Southeast Tech, you've got the Tech High School within a couple blocks. You're right on the boundary of the new high school. That new high school is very attractive. All the athletes want to go there. They kind of team up and go to that school. There's two more schools, an elementary and a middle school, only a few blocks away. And there is a park system that's all tied together through walking paths. So there's a new park and two new schools just a few blocks to the northwest that are being built. So there's a whole system of schools that is being developed within a few blocks of this property, all walkable. There is a Walmart, Super Center, and an Aldi just a few blocks to the north. And then it's also surrounded by a very nice industrial complex. So there's a lot of jobs, and these are in new, nicer buildings. So it's not like an old downtown loft style businesses. These are nice, beautiful concrete businesses, lots of windows, big parking lots, lots of green space boundaries. So these are like all the new industrial type jobs, and we're right amongst all that. Like there's an Amazon just a couple miles to the north, a huge industrial park up there. There's actually two industrial parks up there. The second one has just gotten underway. So there's lots and lots of jobs in this area as well. And then it has good access to the interstates. I-29 is just a couple blocks to the east, and I-90 is maybe 2 miles to the north. So very good infrastructure all around. Everything's brand new in this location.
And Caleb, what about the city's plans for this area? There's some infrastructure stuff that we were discussing as well.
Yeah, I mean, I really think right now the city is just trying to play catch up behind the private development in this area and the growth. And that's evidenced by all the new schools they've built. Like Dustin said, they have 3 new schools, K through 12, right within the same region. And just that foundation park where Dustin was describing where Amazon is just a couple miles north, that's a huge push for the city to have that industrial job base up there in that northwest side of the city. And so we're just, we're playing along with the growth. And I think we're really well positioned, especially where that is on Maple and Marion, or on Marion and I forget the cross. Career. So yeah, that's very well positioned for that growth. And honestly, directly in the middle of that growth, as it's more of an infill site.
Once we close this, What are the timelines? What are you looking at? Basically, how does this work?
It's going to be very similar to phase one. So we kind of touched on that earlier. Phase one is about 11 months into the construction process, and we're about to deliver the second building, and we'll deliver building 3 just right around between 12 transitioning into 13 months. And so it's going to be very similar to that. We have 3 buildings in phase 2, same as phase 1, except we'll have 2 36-unit buildings and 1 24-unit building. And so it will take slightly longer because the buildings are slightly bigger, but it'll be about anywhere from a basically 10 to 14 month stretch for us to build out this phase 2. One of the really nice things about the site specifically is that we've already bought the land in terms of phase 1, but 2, we've also done a lot of the underground infrastructure. When you go and do a site for the very first time, you got to go get all the infrastructure from the street, your storm sewer, your sanitary sewer, your water, and you got to deliver that to all the buildings. What was nice about where we are today going into phase 2 is all that infrastructure is pulled out of the street. It's all to building 1, and it's all been stubbed over to where it needs to be for buildings 4 through 6 in phase 2. So as we jump into the construction, we're hopeful to be able to take off a little bit sooner and as it relates to starting the foundations, because we won't have near the amount of infrastructure work to do underground.
So a couple of things here that I did want to point out. Very attractive feature. Another, apart from the usual depreciation, and now we get tax credits on all of our projects as well due to energy efficiency. It's also the opportunity zone. This project is in an opportunity zone. For those investors that are looking to shelter their gains long term and possibly even eliminate that liability, this project becomes even more attractive. Caleb, do you want to talk a bit about the energy efficiency, the tax rate stuff, and maybe touch upon the opportunity zone? And our team will be happy to go into details if and when investors need that information.
Yeah, I just think from hitting the tax credits first, there's a program called 45L through the federal government that provides tax credits to your project if you meet their energy efficiency systems. Now, each project's a little different. It depends on the amount of shared walls and the window size and the type of windows and the HVAC system. So each is really on a case-by-case basis. But the premise of the program is to build an energy efficient building, which we do, provide those details and receive credits to the entity that owns the project. In this case, you get up to $2,500 in tax credits per unit, and those credits are a dollar for dollar offset to tax liability, and they get passed through to each of the investors. We can talk, like in a 1v1 setting, could talk a little bit more about the detail of that. The second federal tax advantage we have is we do accelerated depreciation across these properties under a cost segregation analysis. So you have that with the federal tax credits. The third tax implication for this project from a federal standpoint is the opportunity zone, and that's very unique. I want to say it's about 7 years ago, the federal government created opportunity zones to try to incentivize developers from developing in these areas. And what that allows you to do is you can invest capital, regardless of if you made it in a business sale or a real estate sale or whatever the capital gains that you acquired, stock sale. You can invest that and you can defer your taxes on that investment. So it's very beneficial for people that have sold businesses, have sold out of large stock transactions, and have a capital gain that they cannot 1031. And that is the advantage of an opportunity zone. There's a lot of implications on whether it's going to get extended past 3 or 4 years of when it expires. I'm sure that depends on the election shortly, but right now it is available. It is available for this particular property because of how it was identified by the federal government.
You've heard about the timeline, some of the milestones. Always, we're happy to discuss about the financials, and we have an underwriting video there as well. Here's basically the tale of what the returns we're projecting are. IRRs, Class A to Class C. These are various share classes. 19.6 to 20% is what our target is. Equity multiple 1.9 to 1.93x. Now, roughly, this translates into average targeted returns, annual returns of 24.1, to 24.7%. These are all projections. We're happy to share the underwriting. We have an underwriting video there as well. But just to give you an example of past projects, recently we closed on the loan for Bridal Reserve 2. That was about 50 basis points lower than what we had underwritten. So we had underwritten a higher rate. We got it for a lower rate. Credit to Caleb and the team. And the reason for that is because we're always conservative. We're always padding our numbers. The other big item that you're also going to see is the fact that construction deliveries, basically multifamily deliveries in Sioux Falls, you're going to see the graph on the screen. They are practically zero heading into 2025, and then they really taper down from historical averages in 2026 and beyond. And the reason for that is the same reason that I mentioned earlier regarding the amenities arms race and why developers are having issues. Money now has a cost. When it was free money, every Tom, Dick, and Harry basically decided they wanted to be in multifamily or pick another business. And now what we are seeing is a difference between actual operators, boots on the ground people like Caleb, Dustin, and myself, and people that are mere pretenders. So this is why not only are you seeing deliveries literally go down close to zero for most of 2025, and then kind of slowly getting up 2026 and beyond, which what does that mean? This means that as the current supply gets absorbed, which is getting absorbed very quickly, all of our projects that are delivered in Sioux Falls are over at least 95% occupied at a minimum. So that tells you there's still strong demand. But as supply goes down, Economics 101 tells you that pricing power is going to come back to developers, come back to asset owners. And this is why we are even more bullish on the Sioux Falls market heading into 2025 when the bulk of the units are going to be delivered and beyond. So a couple of final thoughts here. You know, if you want to invest, just if you have an interest in participating, we need to know right away. Either fill in the form on the landing page or book a call with us, and we'll be happy to answer any questions. The form is pretty simple, actually. You just put in your contact details, the amount you would fund, and we'll get back to you within a business day or two and connect you with any of the legal documents or the funding and the funding instructions. Now, if you want to discuss, if you want to talk, Dustin, Caleb, and I are always available. Happy to discuss. So feel free to reach out. Guys, any lasting comments from you guys?
I have a couple of comments just on some minor things that I thought of that save money. One is we did not put a leasing office in the first phase. And that just kept our costs down a little bit. We used a 2-bedroom unit that was right off of the parking lot, worked perfectly for our leasing office. And there was no complaints from the RPME guys. They said, yeah, it works great. We can show them a unit and have a leasing office at the same time. As soon as that fills up, then they just move to building 2, pick another leasing office. So we won't put the leasing office in until the second phase. There was some savings, as Caleb stated, in the underground, as the underground is already stubbed in. But then also there was a parking lot reduction. So we don't have to have as much parking as when we built phase 1. And so we can use some of phase 1's parking for phase 2. And so that was another thing. Caleb was able to remove the underground parking out of the second phase and use some of the additional parking there. So that really alleviated some costs as well. So just those little things, they're just across the board of some examples of what we do. And we're constantly finding ways like that to tweak the plan to improve the bottom line.
What I love about this project is really the phase 2 aspect of it. You know, when you do development, the biggest risk is being able to remove the risk of the construction and the lease up. Now, you can't do that 100% in this because you still have phase 2 to do. But in the last 12 months, what's happened in phase 1, the buildup, hitting the cost projections, leasing it up, you've removed just a large chunk of that risk in a development. And so this is a unique situation where you get the best of both worlds. You get to buy into something that already exists and is operating and is stabilized or stabilizing, and you also get the upside of the development.
Wonderful. Thank you, guys. Really appreciate it. So once again, if you have any interest in participating, we need to know very quickly. These things get filled up. You can fill the form on the landing page. You can give us an email, phone call, book a time with us. Happy to answer any questions, and we're looking forward to partnering with you.